Okay, this is Professor Hazara. This is the second in the two videos, the second out of three total videos that we're going to do on this problem. And in the first video, I introduced you to the problem. And just to recall, it's a one-year acquisition, 2011 problem. The shareholders' equity consisted of the parent bought 70% interest in the subsidiary for $490,000 cash right there. And the shareholders' equity consisted of $500,000 capital stock and $100,000 retained earnings. The difference between the two, so they're paying 70% they're paying $490,000 for 70% interest in a company with total equity of $600,000. Okay, so they're overpaying, if you just basic arithmetic. Okay, and the difference is they're overpaying. They're paying an extra $5,000 for undervalued inventory, $14,000 for undervalued buildings, $21,000 for undervalued equipment, and $60,000 for goodwill. So they're basically telling you the goodwill calculation here. With respect to the amounts to be written off in the income calculation, the undervalued inventory items were sold during 2012, so through 2011. So all of the inventory items are going to be written off this year because this is a 2011 consolidation. The undervalued buildings and equipment had remaining useful lives of 7 and 3 years each. So buildings will be written off over 7 years. Equipment's going to be written off over 3 years. Depreciation is straight line. Then there's one reciprocal payable or receivable right here. And then finally, there's some irrelevant information because it's an old CBA exam problem. They always throw relevant information. This says Par sold equipment with a book value of $15,000 for $25,000 on June 1, 2011. They're just telling you that the parent sold some equipment. And it's not an intercompany transaction, which you'll learn about in a couple of weeks. But so it's totally meaningless information. Okay, now what I emphasized in the last video is that these are the financial statements, the ones you see here. These are the financial statements that we're going to use for the consolidation. And the two numbers I have circled there, the income from sub, which is 60.2, and the investment in sol, which is 515.2, those are the two accounts that prove that the parent has used the equity method. Those result from the parent using the equity method on its own books. Okay, so now we're going to go ahead and do the consolidation, and we'll do the calculations. I'll do the calculations in this video, and in the video after this, I will do the consolidation itself. Okay, so let's go ahead and go to the worksheet, as they say. Okay, and so I just want to go here. We're going to do the calculations here, and notice that basically we're going to have one extra calculation. We're still going to have the goodwill calculation, the income from sub calculation, and the analysis of the investment account. Still going to have all those calculations, but what we're going to have, and those are consolidation entries right there. We're going to finish this consolidation in the next video, not this one. I want to just show you, emphasize like I did last time, that the parent's financial statements, which are basically these two columns here. The third column is the sub's financial statements. These are the post-equity method financial statements. And that's proven because the income from sub, there it is, 60.2, and the investment in sol is 515,200. And those are the same exact financial statements which were on this in the text of the problem. All I did was move them onto a worksheet. Okay, so let's start the calculations, and then we'll finish up in the next video. Okay, so in the preliminary calculations, we're going to have the usual calculations. And keep in mind that the big difference between this consolidation and the one you just did, you're doing for homework, is doing a couple days, is that this one is not a 100% acquisition. It's only a 70% acquisition. According to accounting standards, when you acquire less than 100% controlling interest, between 50 and less than 100%, you've got to not only account for your investment, you also have to account for the investment in the what we call non-controlling interest. They're kind of like your siblings or your kids in a sense. Okay, so anyway, we're going to have goodwill calculation, income from sub calculation, and we're going to also do the analysis of the investment account. That's what we'll do now. Okay, so let's start this. There is going to be one extra calculation we do, but it's incredibly simple. The first thing we have to do, you have to do when you don't have a 100% acquisition, is you have to calculate what we call the fair market value. Basically, you have to calculate the parent's estimate of the fair market value of the other company. It's a very easy calculation. And here it is. What we're going to do is we're going to take the cost that the parent paid. We're going to take the cost that the parent paid, and let's see, going back to the text of the problem here, the parent paid a cost right there of $490,000. Okay, so the parent paid the parent's cost was $490,000. Okay, and what we're going to do is divide by parent's ownership percentage. So I'll just say ownership percentage. And we know that the parent got 70%, so it's 0.70. Okay, and I'll even put percentage there just to make it seem official, let's say. Okay, so the parent bought 70%. Now, logic has it that if the parent thinks that 70% of the subsidiary is worth $490, that's what they're paying for it. If you take $490,000, and divide by 70%, that should give you what the parent thinks the company is worth. So if we take the 490 and divide by 70%, we're thinking that the parent believes, and I'll move this down here, this $700,000 right there, that's what the parent thinks that the entire company is worth. So if it pays 70%, and basically 490 is 70% of 700,000, but it's logical. If it pays 490 and they for 70%, they think the whole company is worth 700,000. So the difference between the 700,000 and the 490 is that 30% non-controlling interest. Okay, and let's go ahead and make these dollars. Go ahead and make these dollars right here. So this is foreign cells, and make these dollars currency right here. Okay, so next, so this number here is what the parent thinks 100% of the subsidiary is worth. Okay, and that number is going to be the sort of anchor for all the other calculations that we do here, especially the balance sheet calculations. Okay, next, let's go down to the goodwill calculation. Okay, and goodwill calculation, notice that going down, it's the same as before. We're going to have the cost. It's the fair market value of the firm is the same as the cost. We'll subtract out the net book value. We're going to get a valuation difference. We're going to take out the 5 items for which the 3 items for which the parent overpaid, the 3 tangible items, inventory, buildings, equipment, and the leftover will be goodwill. Okay, so let's start with this. The fair market value of the firm is $700,000. So we have a 100% column there, and so the fair market value of the firm is $700,000. Now, the net book value, we're going to have all this right here is going to be our 100% column. Okay, now the net book value of the firm, let's go back to the text here. Net book value of the firm consisted of 100,000 capital stock, and $500,000 capital stock, and 100,000 in retained earnings. So 600,000. So we're going to come back here, and I guess we'll put here common stock is 500,000, retained earnings is 100,000. I'm just putting them there so you can remember. So the total equity that we're going to compare that 700,000 against is 500,000 plus 100,000, or 600,000. Okay, so our total difference here is 100,000. So you're overpaying by 100,000. And what we've been saying in the equity method, in business combinations and all that, is that there's 2 reasons why you overpay. One are for tangible reasons, the inventory, the buildings, equipment, and the intangible reason is that leftover reason, and that's goodwill. Okay, so how do we take, what are the numbers that we're going to subtract from this right here? Well, they've been given to you. Go back to the text of the problem again. And it says here that they're paying $5,000 right there for undervalued inventory, $14,000 for undervalued buildings, $21,000 for undervalued equipment, and $60,000 for goodwill. So they're giving you the undervaluations. You don't have to take the fair market value and subtract the book value and all that. That's being given to you in this problem right here. Okay, so just keep those numbers in mind. And what they're assuming is that they've already done all the math work, and they have calculated that inventory is undervalued by 5,000, that buildings are undervalued by 14,000, so we'll subtract 14,000 there. That equipment is undervalued by 21,000, and we'll do minus 21,000 right there. And the remainder is goodwill, and they basically already told you. Go back to the text of the problem. This actually is a very easy problem in a sense. They've already told you, underline this, that goodwill is 60,000. Okay, so the way to read this problem is they're giving you the goodwill basically. So if you take the 100 and then add in all these negatives, which are basically subtractions, you get goodwill of $60,000 is what you get. Okay, now if we were doing just 100% acquisition, we would just go on to the income calculation, no problem. The issue, though, is that you don't own all the company. You only own 70% of the company. So we're going to have a 70% column here. Format this, and we'll make this a percentage without 2 zeros. We'll make that percentage, and we'll make, just a minute, we will also make this number percentage here too. The right buttons there. Okay. I'll make that a percentage. So we're going to be split. What we're going to do is split this 100% column into between the 70% and the 30%. Okay, and let's just go ahead and do that. Okay, and the easiest way is just to take the 70% and multiply it times the value of the firm. That gives you 490. Just happens to be what you paid. Okay, and let's go ahead and freeze the 70% here. Let's freeze it with dollar signs. And so we'll just go ahead and copy down. So these are the values of this is your 70% ownership in the equity of the company, which is 420. Your ownership, your share of the inventory write-up, because it was undervalued, the fair market value is greater than the book value. Your share of the building write-up, your share of the equipment write-up, and 42,000, which is 70% of the goodwill. So you have some wealth in the company. However, you don't own all of it, and now we've got to do the same thing for the 30%. So in a sense, the calculation is the same as when you do 100%. However, we're going to have to do them, we have to split them 70-30 in this case. If you had 80-20, you split them 80-20. Okay, so let's go ahead and split this and take 30% times 700,000. It's 210,000. Okay, right there. And we'll freeze, we've already frozen the numbers there, and let's make sure we get those. And these will give you your interest that the minority that the non-controlling interest shareholders own in the company, because they're partial owners too. They're kind of like your junior partners, let's say. Okay, so we've got 3 columns: 100%, which is the whole company, which is associated with 60,000 goodwill; 70%, which is the investment account. Notice I put investment account here because you're only going to be reflecting 70% in the investment account. And then finally, the non-controlling interest, which is 18,000, and it's 30% of 60,000. Okay, so far the goodwill calculation is exactly like we've done it, but we split it 70-30%. We're going to do the same thing. Now we're going to do the same thing with the with the write-off amounts. So because we have to write off one year 2011, so we're going to have to write off all of the inventory because it was sold in in 2011 through cost of goods sold. We're going to have to write off buildings over, I think it's 21 years or 14, I don't remember. And then we're going to have to write off equipment over 3 years, I believe. Okay, so let's go ahead and put the years here. 1, 2, I think 1, not 21, 7 years, and then 3 years. And I'm getting those, where I'm getting those from is the second paragraph here. It says that inventory items were sold in 2011. So the inventory items were sold in 2011. The buildings and equipment had remaining useful lives of 7 years and 3 years, respectively. Okay, so it's going to be 1 year for the inventory, and 7 for the buildings, and 3 for the equipment. Okay, so let's go back, and those are correct. Okay, and I just put those out there to mark them down. Okay, so what we're going to do is for the 70% write-off, we're going to take the 3,500, this is for inventory, and divide it by 1 year. So the entire, excuse me, let's get this right. The entire inventory is going to be written off over 1 year. And we'll do the same thing for the minority interest, because we're going to actually adjust the income that belongs to the minority, to the non-controlling interest shareholders. Minority interest, non-controlling interest, same thing. We're going to adjust that income for these overvaluations too, or for these undervaluations. Okay, so negative 1,500 there. Okay, 9,800. We're going to actually write that down over 7 years. The same goes for the 4,200 for the non-controlling interest for our 30% junior partners. And then for the 14,700, we're going to be writing that off over 3 years. And the same thing we'll see for the non-controlling interest. So these are the adjustments that we're going to make in the income calculation beneath. Those are the calculations. And goodwill will not be written off unless it's impaired, and we know that it has not been impaired so far. Okay, so now let's go down to the income from sub calculation. And I have a 70% column because only 70% of the income belongs to you, and I have a 30% column. And let's keep in mind dates here. Go back up to goodwill, and keep in mind that goodwill is calculated 1/1/11. That's the date of acquisition. You only do it once. Now we're into the year, and this is income from sub. Income is for the year 2011. Okay? And then so we're going to start with the sub's income. We're going to multiply it times 70% and 30%, and then make our adjustments like we have been doing. Okay, so let's do this. Let's say we have income from sub, and where do we get our income from sub? We know that income is for 2011. I keep saying in both the recordings and in class that they should always pick up income from the subsidiaries' financial statements. You cannot go wrong. You absolutely cannot go wrong if you pick up the income, the basic income, from its own income statement. So let's do this. Let's go down to the consolidation. That's the only place you're really going to get their real financial statements. And there it is. The 2011 net income was 100,000. Okay, so we're going to have 100,000 in both these columns. Now I'm going to take the 70% column. I'm going to take that income by 70%. The 30% column, I'm going to take it times 30%. Okay, so you're going to go ahead and format that and make that percentages. Okay, so this will be unadjusted share of net income for both the controlling interest, which is 70%, and the non-controlling interest, which is 30%. Okay, so obviously you're going to get 100,000 times 70% gives you 70,000 there, and then you're going to get 100,000 times 30%, which gives you 30,000 there. Okay, and we'll go ahead and underline those. And then we'll bring down our adjustments. And now our adjustments are going to be right from the goodwill calculation above. So our adjustments for the parent, for inventory, I'm going to write off the entire 3,500 share of undervalued inventory. The buildings, I'm going to be writing those off over 7 years. 1,400 is 70% for the parent. And for equipment, we'll be writing off 4,900, which is the amount for the parent, the 70% amount. So the parent share of net income is going to be 70,000 plus all these three negatives here. Okay, so the parent share of net income is 60,200. We'll match that up in a second. Let's finish the non-controlling interest. Non-controlling interest, you're going to do the same thing, but you're just going to go over here to the non-controlling interest column. Okay? And so the non-controlling interests are basically the 30% write-offs. Okay, so for non-controlling interest income is 30,000 plus 15, it's negative 1,500 plus negative 600 plus negative 2,100. So your non-controlling interest income, let's see if it takes us 25,800, and it looks like we're on the right track here, 25,800. Okay, and always when you finish income, when you finish the investment account, always match them up with what is on the parents, the income and investment, which are on the parents' balance sheet, to make sure you're on the right track. So we got 60,200 in income. If the parent is using the equity method, that's the income it should have. Notice it matches. There's income from sold, 60,200. Always match them up. You know you're going in the right direction. Finally, we'll finish this video with the investment account. And the investment account is going to be extremely important here. I'm going to go ahead and just put a little, insert a row right here. I'm going to insert an entire row right there. Okay, and now notice I have 6 things here, 6 items, line items: common stock, retained earnings, inventory, buildings, equipment, goodwill. You always pick those off of the goodwill calculation. Always start with the equity items, common stock, and retained earnings, which is right there, common stock and retained earnings. If you had additional paid-in capital, you would put that in there too. And the only other items you can have in there are any revaluations and goodwill. Inventory, buildings, equipment, and goodwill. And right here I have inventory, buildings, equipment, and goodwill. Okay, now we're going to be doing this beginning of year, end of year approach that I did before. I'm going to be doing it that way. Okay, and what we're going to do is I'm going to fill out the 100% column first. That's the easy one, and we'll just split it 70-30. Like that. Okay, and so everything above this line right here, will be the beginning of the current year. And the current year, it's a 1-year problem, so the current year is the year of acquisition. Makes it an easy problem. And then everything underneath there, we're going to add income, take out the dividends. That will get us to our end of year balance. And that's where we'll end this video, and then we'll do the consolidation entries and the consolidation in the next video. Okay, so let's start here. So everything above this line here, all these items have to be correct balances as of 1/1/11. Okay, well, it looks to me common stock at 1/1/11, goodwill is calculated at 1/1/11, was $500,000. Keep in mind that it's the beginning of the current year. So if we were doing this for 2012, it would be a 2012 consolidation. Okay, then retained earnings, 100,000. That was your retained earnings as of 1/1/11, and then your inventory is it was really written up because the fair value was greater than the book value, but they call it undervalued for some reason. So 5,000 for inventory, just like you did on the test. You flip the signs. 14,000 for equipment. 14,000 for buildings. Equipment is negative 21,000. Then goodwill is 60,000. Okay, so let's just add up the 100% column here. And the 100% column will add up, and this will give you your beginning balance for 100%. So we'll just do the sum function here, add them up, and at 100%, that gives you 700,000. That makes sense because when you bought this company on January 1st, 2011, this is a first-year problem, makes it easy. You thought that the value of this company is 700,000. Notice all these 700,000 are all the same number. This one here is just broken down according to its components. 600,000 of equity and 5,000, 14, 21 of valuation differences and $60,000 of goodwill. Now let's just split it. We're just going to go ahead and split it 70-30 because you only own 70% of these things. So let's go ahead and for this column here, let's go ahead and take each one of these times 70%. So 70% is going to be times 500,000. Just a minute, I got that. Is equal to 7% times 500,000, which is 350. And we'll go ahead and freeze the two column in the row. And then we'll just go ahead and copy down. Okay, so those are the balances for the controlling interest, which is the investment account, by the way. And let's go ahead and just sum them up, and we can just copy the sum over from that 700,000. We'll just copy that over. 490. And so our beginning balance in the 70% controlling interest, which is also your investment account, is 490. And that shouldn't surprise you because let's go ahead and underline here, because the 490 is your balance as of the date of purchase. Keep in mind that you bought this company for 490 on January 1st, 2011. This is a first-year problem. That just happens to be equal to the cost of your 70% acquisition, 490. So that makes total sense. When you bought it, you debited 490. You debited investment 490 and credited cash for 490. There's your 490. This is just telling you the components. Let's do this for the non-controlling interest. Okay, so for the non-controlling interest, we'll just take this 30% here and multiply it times the 100% column. It gives you 150,000. Go ahead and freeze the 30% there, both the row and the column. We will then copy down. And my feeling is that you're going to get 210,000, which is 30% of that 700,000. That's their interest. Let's go ahead and verify that. 210. Okay, so all we're saying is that at 100%, this company is worth 700,000. Your share, you're the investor, you control it. Your 70% share is worth 490, and non-controlling interest share is worth 210. So that's a good thing right there. Okay, now to finish the investment reconciliation, we're just going to add in the net income for each one of these, and then we're going to take out the dividends for each one. Okay, so the income is, the incomes are just brought down from your income calculations up on top. The controlling interest net income is 60,200. The non-controlling interest income is 25,800. Okay, and the only thing left, so you took the equity method, you bought the company, you added net income from the income statement, adjusted for the revaluations, then take out the dividends, and then we'll come to our ending investment balance. Okay, so the dividends, the easiest place to get dividends. I cannot emphasize this enough. The easiest place to get dividends, and it's going to be a negative, for the year is and let's go ahead and put this dividends over here. and we'll split them 70-30. So what we're going to get is we're going to take the dividends, and the dividends are always going to be on the subsidiary statement of retained earnings right here. Okay, so hope I did this in class. Now we'll go back over it. Okay, so the dividends are a -50, and in a sense, I don't need that because they're always -50. I'm just going to split those at 70% here. So this is going to be equal to your share of the dividends, 70% -50,000, -50,000, and the non-controlling interest is 30% times 50,000 there, -15,000. Okay, so your ending investment balance, according to the equity method, so all the equity method is purchase price of $490 plus your adjusted share of income, $60,200, plus your share of dividends, which, by the way, I don't know, I could be getting 35,000 there. I'll change that in a second. Is I say 50,000, but that should be. I don't know why that. I thought I had that. Okay, this should be 35,000. Let's get this 35,000 equal again. 70% times -50,000 is 35,000. And then the non-controlling interest. So your investment account should have a balance on it, 515,200. The non-controlling interest, the beginning balance, their beginning interest was 210,000, which is 30% of the 700,000. Add in their share of income, which is from the calculation up on top, and just take out their share of dividend, which I picked off from the statement of retained earnings, and the ending non-controlling interest, 220,800. And that's where I'm going to stop this video. This calculation here, this whole reconciliation right here, whole reconciliation right there is going to be the basis for 4 important. We're going to add 1 entry for non-controlling interest. Okay, this is going to be the reconciliation for, or the basis for those 4 entries right there. You can do this reconciliation of the investment account, of the wealth of the company, basically, and you're good to go for the journal entries once you get the pattern down. Now, I just want to notice that I'm saying that the investment account at 12/31/11 should be 515,200, and lo and behold, if we go down to the parent's balance sheet here, you're going to have, there's your investment in Sol, 515,200. Those 2 things should always equal if they're using a full equity method, and they are. So we're ready to go and start the consolidation. I may do the journal entries in the next video, which would be short, really, then just post them in maybe a 4th video. Okay, so anyway, I'm going to get off and start the next video.